Hello and welcome to the Business Standard Morning Show. I'm Devargya Sanyal. It's the 13th of July 2023 and here are the questions we'll be answering today. Can online gaming survive the GST sucker punch? Can Triumph and Harley take on Royal Enfield? What should investors do in case they miss the market rally? And what are tax havens? The Goods and Services Tax Council on Tuesday decided to levy 28% tax on full face value for online gaming. While the council said the move will help regulate the online gaming industry and make it fair and transparent, industry stakeholders said it will deal a killer blow to the emerging sector in the country. We ask industry experts how the next levels might be stacking up for the online gaming industry.
India's online gaming market was worth $2.6 billion in FY22, and it was expected to reach above $5 billion by 2025. Its compounded annual growth rate is a staggering 38%, and the country is currently home to 900 gaming startups. So in April this year, when the government notified a new set of rules for the online gaming industry, it was widely seen as an attempt to regulate the sunrise sector, and its prospects were believed to be bright in the country. But on Tuesday, the 50th GST Council meeting announced to levy a 28% tax on the total entry amount for online gaming. It is being seen as a major blow for the burgeoning industry. It comes at a time when the Indian gamer profile was evolving. Deloitte says that nearly 40% of gamers today are women, and there has been a rapid growth of gamers in the 30+ years category. Mobile is a dominant platform preferred by 98% of gamers. A large chunk of these new gamers also includes middle and upper middle class players who feel confident in making small and casual investments in online gaming, thanks to the increasingly lowering threshold of entry fees for online games. An estimate by the All India Gaming Federation says that over 50,000 direct jobs have been created by the sector so far, with the expectation that over 350,000 direct jobs and 10 lakh indirect jobs by 2028. So why did the government take this step?
The reason why probably they would have gone down this mode is there was no consensus at the GOM level with regard to how this particular industry has to be taxed. So they went with the popular opinion across the constituents of the GST Council that how this industry should be taxed at an overall level, keeping in mind the challenges which as a government is facing from several online companies and several online gaming companies. This industry is viewed with the mindset that maybe this is something which needs to be discouraged as a activity per se. Maybe these would have been the possible considerations which the government may have had in deciding what they have decided.
Earlier, online betting and gambling were taxed at 28%, while 18% GST was applicable to the gross gaming revenue of online games. The new tax will apply to the total amount of money deposited by players. So far, according to AIGF estimates, the online gaming market's overall contribution in GST reached above 2,200 crore rupees in the last financial year. Industry stakeholders, including gaming companies and industry bodies, have expressed their discontent. Bhavin Pandya, co-founder and CEO of faming unicorn Games 24/7, says the move is not only counterproductive for the sector but will also lead to loss of employment for thousands working in this sector. Malay Kumar Shukla, Secretary of E-Gaming Federation, also points out that the GST rule goes against the various judgments that have distinguished online gaming from gambling. What then might be some of the immediate and specific impact of this new GST rate on the gaming ecosystem?
The impact is going to be across the ecosystem. So just to lay out certain facts here, on the gaming company or platform, the impact will be an upside of 1100% if the valuation moves from the GGR, present level GGR, to the face value as was indicated in the press conference yesterday. For the online gamer, it is going to be 300% or 3 times more expensive for him or her to participate in a game. The GST applicable of 28% would be more than the revenue of gaming platforms.
This rate being charged at 28%, I think the industry was more or less ready to accept that. But what, in fact, has been, as you call it, a killer blow, has been the entire 28% on what it applies. The industry has been paying GST only on the platform fee or the GCR that they call it. But now, with this change, the industry would be required to pay 28% GST on the entire money that they receive from their customers, which means the entire gross value that the gaming companies receive, from which they also get their platform fees, the entire thing would be subject to a 28% levy by treating it as 128%, which will sort of impact the participants to think whether they want to participate, and as a result impact the investments that are lined up for this sector. The overall growth and popularity of this particular sector can take a beating.
So what's next for the gaming industry? What is the way forward in face of the GST roadblock?
We sincerely hope that there will be a rethink and a progressive tax regime is brought, which will help the industry grow while increasing tax revenues. The intent is to increase tax revenue. So with that objective and intent, we believe that there should be a progressive tax regime, and we are hopeful of this.
But Union Finance Minister Nirmala Sitharaman said the intent was not to end any industry linked to online gaming, but there was a discussion on the moral question of whether these should be taxed at the same rate as essential items. But the industry is clearly not happy. Experts are hopeful that the government will rethink the GST on the gaming industry given the rapid rise in interest in the gaming market across Tier 1 and Tier 2 cities.
While the future of online gaming hangs in balance in India, its roads, it seems, are gearing up for a clash of titans. Two international motorbike giants, Triumph and Harley Davidson, are revving up to challenge the might of Royal Enfield. The Enfield has long been ruling the mid-range bike segment in India and has a dedicated fan following. So, will the new entrants have enough horsepower to topple the Royals' empire? Tariq Ahmed charts the route ahead.
June 2023 was a challenging month for most motorbike manufacturers in India. Companies like Honda and Hero saw a decline in two-wheeler sales, but the sales of Royal Enfield bikes went up by 34% during the month. In fact, Royal Enfield marked a record sales of 834,895 motorbikes in FY23. When it comes to performance-oriented two-wheelers, Royal Enfield has been the go-to brand in India. With their own R&D facilities, Royal Enfield made timely interventions in the Indian market to catch new trends and, more often, made new trends. The 350cc engine of Royal Enfield had the most success of it all. The Himalayan and 650cc models like Continental GT and Interceptor also have a growing customer base in India. The new models like Hunter 350, Super Meteor 650 and Scrambler 411 have continued to put the Royal Enfield brand in the front seat of off-road, on-road and retro bike experience in the country. However, the indigenous Indian motorcycle brand now has some international muscles catching up. Triumph, with its new models, the Speed 400 and the upcoming Scrambler 400X, and Harley-Davidson's new X440 are targeting the same market dominated by Royal Enfield. Despite Java and Honda also operating in the same category and price range, they have been unable to keep up with Royal Enfield. Nevertheless, Harley-Davidson and Triumph's re-entry into the Indian market at a price as low as 2.3 lakh rupees can be a game changer. Triumph's Speed 400 has already been reported to have received 10,000 bookings in the first 10 days alone. So, can Triumph and Harley take on the Royal Enfield?
So both, Hero, Harley and Triumph Bajaj are looking at diversifying and bringing in, a kind of between a 350 to 500 cc motorcycle, right? So you're going to see that segment see a lot of option, which is not there earlier. And it can have two effects. One, it can grow the segment, right? Because the price points of both these different new vehicles will be significantly different from the Royal Enfield price point. So it could grow the segment, bring new customers into the segment, right? And others could also add to the Royal Enfield customer base. So this is a win-win-win situation for all three of them. The other option is that some of the users from, let's say, the Royal Enfield segment upgrade and go to the Triumph and the Harley segment, and therefore there's a shift in market share. Both the possibilities are there, but how it plays out in the future is anybody's guess.
There has also been a shift in the customer preferences for bikes above 250cc segment, and that has turned in favor of rider-friendly utility bikes.
At the heart, this particular category that we are talking about, 250 to 500, still comes and delivers two purposes to the customer. One is the commuter kind of work, which is from to and fro to my place of work. And the second that it helps deliver is the leisure riding, right? So we are beginning to clearly see that there is a particular category of customers who's willing to shell out more money for more packaging, for more branding, and for more style, right? These are the three things that customers value.
Actually, this is a phenomenon across the automotive industry. There's a segment, even in the car segment, which is properly referred to the SUV segment, or which has been growing in that segment. And similarly, in the two-wheeler segment, this segment has been growing. Right? It actually looks at upgrading existing customers from one end to another end, and also looking at the Gen X and the rider family. So these products are more of a rider family products, right? And some utility products. So Royal Enfield has got both, right? And therefore, you're seeing this segment grow. And therefore, people are looking at this segment. And also, as was mentioned, by two of the industry leaders, the profitability in this segment or return on investment in the segment is also better than the other segments.
Motorcycle enthusiasts in India have exhibited a growing inclination to invest more in utility bikes, and Royal Enfield has emerged as the prime beneficiary of this trend. The entry of Triumph and Harley-Davidson in the same segment will bring more customers to the 250 to 650cc segment while creating competition for Royal Enfield.
Let us now turn our gaze to the markets. Equity investors are making hay as key indices hover around record high levels. But what about investors who have missed this rally since March 2023 lows? Have they completely missed the bus, or are there pockets that still look attractive? In our next report, Nikita Vasisht talks to market pundits for answers.
Indian equity markets have been on a steady uptrend over the past 1 year. Since July 2022, the Sensex and Nifty 50 indices have surged around 20% each. The mid-cap and small-cap indices, meanwhile, have rallied up to 30%. The gains have been on the back of foreign portfolio investor flows, who have been net buyers in 8 of these 12 months. Moreover, stable macroeconomic conditions, with inflation mostly in check, supported the momentum. While the indices have given a good performance, a lot of stocks turned multi-baggers during the period. Therefore, those who have been in the markets for a year are sitting on meaningful returns. But what if you missed riding the upswing? Is it too late to start?
Things like waiting for a correction, etc., is not easy to do. In fact, lots of analysis and studies suggest that waiting or trying to time the market does not really add much value. So my recommendation would be that try to invest on a regular basis, especially with a long-term horizon in mind.
That said, this 20% gain at the headline level wasn't a one-way rally. Between December 2022 and March 2023, the benchmark indices tumbled up to 10% amid Adani Hindenburg research row and banking crisis in the US and Europe. Trideep Bhattacharya of Edelweiss AMC thus cautions investors against further volatility.
That overall this year should be used, or this year's volatility should be used as an opportunity to invest in preparation for the rebound, which will likely ensue over the next 2 to 3 years. Since last November, the markets, because they just hit all-time high, have been by and large flattish. It could be another way to think about this. But if you look at from a company standpoint, in the last year, the earnings have grown anywhere between 15 to 30%. So clearly the valuations today are a lot more reasonable 1 year forward as opposed to a year ago.
Bhattacharya suggests these 5 themes to bet on.
First, basically, we think that a strong private sector capex is up in the horizon. Second, we think that the real estate sector could be sort of, in the middle of an upswing for the next 5 to 7 years. Third, we think that overall defense could be a strong area from an investment standpoint, from a multi-year perspective. Fourth, we think that lending financials could be a good place to be overall from a couple of years standpoint. And finally, we do think that China plus one could be a pertinent theme to play.
In a nutshell, long-term investors could still enter markets on dips and add quality stocks across sectors. Today on July 13th, investors would react to India and US's CPI inflation data along with Q1 FY24 results of TCS and HCL Tech, released post-market hours on Wednesday.
He's making plans for an early retirement. Business Standard.
FPI flows into the Indian equities hit a 10-month high in June. It is also fueling the ongoing gains in the stocks. But a part of this money is coming from so-called tax havens. In today's Decoded segment, Rimjim Singh tells us more about tax havens and why they have become a favorite.
A tax haven is a country or jurisdiction that has policies which enable it to tax income or wealth of individuals or businesses at lower rates than other jurisdictions. Tax havens provide an escape route from financial regulations, disclosure, and criminal liability. Such countries do not ask businesses to operate out of their jurisdiction or individuals to reside in their country to receive these benefits. These tax havens have long been a haven for big corporations and wealthy individuals to evade taxes. Businesses and individuals use loopholes to shift profits between subsidiaries to save taxes. In 1998, the Organization for Economic Cooperation and Development gave a list of factors for identifying tax havens. There are 4 main factors. First, tax haven nations offer negligible taxes for earnings made under the jurisdiction of the tax haven nation, but it may vary with different countries. Second, tax havens should maintain secrecy of information and they should protect their clients' personal and financial information. Third, tax haven countries lack transparency. Financial information is not disclosed to national governments. And lastly, tax haven nations do not require outside entities to produce goods or services within their jurisdiction. Most tax havens charge a fee for new registration of companies, and individuals have to pay renewal charges every year. Additional fees may also be charged as a license fee. Such charges would add up to a recurring fixed income for the tax haven nations. So one can ask how these countries which offer such tax benefits to foreign entities make money. Well, these tax havens benefit from the capital which comes into their economies. They also supplement lost government revenues by imposing tariffs. They make money via customs and import duties. In some cases, these tariffs are higher and it leads to a higher cost of living. India has signed double tax avoidance agreements with a host of countries. It has also signed limited agreements with 8 countries. According to PwC, these treaties provide for the income that would be taxable in either of the contracting states. India has also introduced the General Anti-Avoidance Rule or GAAR to curb the tax evasion. It was proposed in the Direct Tax Code 2009 and was introduced in the budget session of Parliament in 2012, and it came into effect from the assessment year 2018-19.
Nation's trusted bank, SBI, the banker to every Indian.
But India's gift city is set to pose a challenge to these tax havens due to the liberalized investment rules. Well, that's all for today. For more news and analysis, please log in to business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.